In the fast-evolving cryptocurrency market, a deeper understanding of seasonal trends in Bitcoin and other digital assets is emerging as a crucial tool for investors seeking to optimize their portfolios. Traditional finance, with its long history of documented seasonal behavior such as the sell in May and go away phenomenon, offers a blueprint that appears to be applicable, surprisingly, to cryptocurrencies as well. This strategy, rooted in the observation that equity markets tend to underperform during the summer months, aligns closely with similar patterns observed in Bitcoin's historical performance data. Research into Bitcoin's seasonal patterns reveals a distinct trend where the summer months, specifically from June to September, consistently underperform compared to the rest of the year. This could be attributed to various factors, including reduced trading activity as traders and investors take summer holidays, or broader economic slowdowns during these months, which affect investor sentiment and market dynamics globally. The strategic implications of these findings are significant. By reallocating investments from Bitcoin to cash or other assets during these predictably lower return months, investors could significantly outperform the traditional buy-and-hold strategy. This kind of tactical asset allocation could theoretically increase returns manifold, demonstrating how seasoned investment strategies from the traditional financial world can be adapted to the newer cryptocurrency markets. Moreover, the evidence suggests that these seasonal trends could offer insights beyond simple buy and sell strategies. Understanding when to increase exposure based on historical monthly performance could be as critical as knowing when to reduce it. For example, the period leading up to June often shows a strong performance, which could be a prime buying opportunity for those looking to capitalize on seasonal strength before the traditional summer slowdown. Delving deeper into the weekly and daily patterns offers additional layers of complexity and opportunity. Bitcoin typically shows stronger performance at the start of the week, with returns tapering off as the weekend approaches. This could potentially be linked to the traditional market activities of institutional investors who are active during standard working days. Or it might be a reaction to the accumulation of news and developments that tend to drop over the weekend when traditional markets are closed. On a daily basis, the fluctuation in Bitcoin's performance across different global trading hours suggests an interconnected yet regionally distinctive market. During European and American trading hours, Bitcoin usually experiences higher volumes and positive returns, likely due to the high concentration of traders and financial institutions active during these times. Conversely, the Asian trading hours often see lower performance, which may reflect regional variations in market participation or the impact of news releases timed for the US or European audiences, which often occur outside of Asian trading hours. This intricate tapestry of seasonal, weekly, and hourly trends in Bitcoin trading not only highlights the cryptocurrency's integration into the broader rhythms of global finance, but also suggests that Bitcoin is increasingly mirroring traditional financial markets in some ways. This integration indicates that cryptocurrency markets are maturing, becoming less of an isolated phenomenon and more a part of the global financial landscape. For investors, leveraging these insights means engaging in more sophisticated trading strategies that consider an array of factors including market sentiment, trading volumes, and the timing of news events. These strategies, while more complex, promise to refine the approach to cryptocurrency investment, blending traditional market wisdom with the new dynamics introduced by digital assets. Ultimately, as the cryptocurrency markets continue to develop and become more intertwined with traditional financial systems, the successful investors will likely be those who can best adapt the lessons of the past to the digital future. This will require continuous learning and adaptation, as the unique features of cryptocurrencies combined with the patterns borrowed from traditional markets create a new frontier in investment strategy.